Did you know you could buy Ozempic or even testosterone and get a tax deduction along the way? It's true. You need to be using a health savings account. Let me explain how that works. There's something called HSA, Health Savings Account. This is a vehicle where if you have a high deductible health insurance plan, you can put up to $4,150 into this account if you're single, $8,300 if you're married. And what happens there is I put the money in and I get a tax deduction, whether I spend it back out or not. And I'm gonna come to using that to cover your Ozempic costs or your testosterone. Well, hold on for a second here. I wanna explain how the HSA works here and how you get the tax deduction. So let's say I just put in $2,000 for the year. I put that into my HSA. Well, you know what I gotta do? I gotta put a $2,000 deduction on my tax return. So if I made 100 grand a year, I'm only taxed if I made $98,000 because I got a tax deduction. Now, that $2,000 goes into the HSA and you can go and invest it. You could have a brokerage HSA, you could do a self-directed HSA like we have, or you can invest in small businesses or private companies or crypto or real estate, whatever you want to do. But I'm just saying you can grow and invest that account and there's no taxes on your investment gains. You're growing it and investing it. But you want to use this account for medical. So you've got medical coming up. You've got the Ozempic bill. You've got dental for your kids. You go to the orthodontist. You have a copay. Those medical expenses you can use the HSA to cover. So if I drop $2,000 in, maybe I've invested it and it's grown and now the account's $2,500. I can spend out $2,500 for any qualifying medical. And that $2,500 comes out of the HSA. You could also spend it personally and reimburse yourself out of the HSA account later. Either way works. But now I've effectively got a $2,000 deduction because I put $2,000 in. I've had some investment gains and I spent the money back out. If I just spent $2,000 on medical right out the door, no tax deduction. It's very hard to write off your medical expenses on your tax return. But by using the HSA, now I get a tax deduction on that money and I can use it for our qualifying medical, which you're gonna have anyways. We all have qualifying medical. It covers dental, it covers your family expenses, it can cover your spouse depending whether you're doing single or family. So now I've been able to get a tax deduction on the money I'm putting in my HSA to cover the medical I'm gonna spend money on anyways. And even if you don't, you can grow that HSA over time. It stays invested, it grows. Now let's say you hit 55 or 65 in your retirement. Do you know what the number one expense is for someone in retirement? It's medical. It can cover long-term care, Medicare premiums, all these medical expenses we're gonna have later on in life. You can still use that account later on as well. So how do you know if you should be doing an HSA qualifying plan? Because it is high deductible. Your deductible might be $2,000, which means you come out of pocket for the first $2,000. Now, a lot of health insurance plans, the deductible is at $1,000. There's very few that are below that anyways. They're very expensive. So if you have a high deductible plan, let's say it's $2,000 deductible, as opposed to a $1,000 deductible, that means you're on the hook for the first $1,000. Now, the HSA qualifying plan, you're still gonna have your copays and your doctor visits, where the insurance company is still paying for that. You've got maybe your $50 for the copay. You still have prescription drug coverage, okay? It's not like you gotta spend $2,000 on prescriptions before you get prescription drug coverage, which by the way, some plans might cover your Ozempic or your testosterone, especially if it's for weight loss management or diabetes. So those things could be covered by insurance anyways with a copay that you might be paying. But if you're looking at using a HSA, remember there is one downside. That is a high deductible plan. Now the benefit is not just the HSA account, but most high deductible plans are cheaper. Your premiums are lower. Most companies that offer an HSA qualifying plan, if you look at it, the premium and typically your cost to get that coverage is going to be cheaper than a low deductible plan, which is more expensive for you and your employer. So everybody's situation is unique, but I love getting the tax deduction, having a vehicle to save and grow that because I know I'm going to have medical expenses in retirement. So let's say you don't choose an HSA qualifying plan. You're like, but Matt, I want to write off my medical. How do I do that? It's pretty much impossible. The rule on that is you can only write off medical that is over 7.5% of your total AGI. Let's say your AGI, adjusted gross income, is $100,000. The first $7,500, 7.5% of your AGI, you don't get a write-off. Only that exceeds that amount, you get to actually take an expense. That would be an itemized deduction. If again, you itemize, you'd still have to itemize, and that would be on Schedule A. Typically, we don't like writing off medical. It's very rare you'll ever see anyone write off medical that is not using an HSA. Now, there's other strategies you can use, like an HRA if you're self-employed here, but the purpose of this, I want to highlight the HSA. I get a tax deduction when I put the money in. That money grows as I invest it tax-free, and it comes out tax-free for qualifying medical that could even include your Ozempic and testosterone if it's prescribed by a doctor and medically necessary. So I hope that cleared up a lot of questions many of you have about, hey, I'm in open enrollment. Should I use an HSA qualifying plan or do a standard medical plan? Or maybe you're someone that's like, like, man, I want to be able to deduct my medical expenses and I haven't been able to do that. Well, it's the HSA. That's how you do it. Now, please subscribe to my channel. I've got a lot of tips on saving on taxes, growing and building retirement, protecting your assets. I'm Matt Sorensen. We'll see you next time.